It's time to understand the format of the income statement and the format of the statement of financial position, which are the basic set of final accounts in a business. Okay, so in accounting, as we say, it's a method of record keeping. So all record keeping will be finally balanced out to two sets of financial statements in accounting. You all would have heard about it. One is the income statement, the other one is the statement of financial position. We call it the balance sheet. The income statement of any business which is prepared in accounting is the statement that will show the performance of the business during the previous period. The performance which is measured by the profitability of the business. How well the business has made profits. Profit means the income over its expenditure. How well the business has made profits. Income statement will show the revenue, income and the expenditure. Revenue minus expenditure is what? Is the profit of the business. So income statement is a statement of accounts that will show the performance of the business. Right? So it records the income and expenditure of the business and calculates profits and loss. So I have given you a basic example of an income statement. Just see. Revenue is the top line of the income statement, and from that you reduce all the expenditure. So revenue from merchandise sale, music lesson income, total revenue 27,800. From that you reduce all the expenditure, cost of goods sold, depreciation, wage, rent. You reduce that, you deduct it. Then you will get the net income, which is known as profit. So when the revenue is more than expenditure, you call it as profit. When the revenue is more than expenditure, you call it as profit. And when the expenditure is more than the revenue, you call it as a loss. So once again I'm repeating, income statement is the statement of accounts that will show the performance of the business, that will show the profit or loss of the business during the previous period. So income statement will show the revenue minus the expenditure and the profit or loss generated for a particular financial period. Then the statement of financial position. Now income statement has shown the performance. What's the profit or loss of the business? And the statement of financial position will show, we call it as the balance sheet as well. Balance sheet, statement of financial position. Most earlier it was referred to as the balance sheet, but nowadays we call it as statement of financial position. So statement of financial position will show the financial position of the business, that is the values of assets, liabilities and equity for a given date. The values of assets, liabilities and equity of a business as at 31st March of a particular year for a given day, what's the value of assets, liabilities and equity. That is being shown by the statement of financial position, or we call it the balance sheet. So income statement has shown the profit and the statement of financial position shows the net worth of the business. It is showing the assets, liability and equity. So if you go through, if you see this particular sample statement of financial position, you will see assets as well as how it is being financed. So fixed assets, we will learn it in the next slide. Fixed assets, that means assets that will be held for long period of time, and current assets, what's the value and how it is being financed by capital and liabilities. So that is being shown by the statement of financial position, how assets of the business is being financed, whether it is being financed by equity, that is shareholders capital, as well as from the borrowed funds, that is loans and current liabilities. That is being shown by the statement of financial position. So income statement has shown us what's the performance of the previous period of the business. That is what? That is income, revenue minus expenditure. That will be the profit or loss. And the statement of financial position, or we call it as the balance sheet, will show you what's the position of the assets, liability and equity of the business. Statement of financial position as at a given date. Let's say in this particular example is the name of the business and statement of financial position as at 31st December 2017. So in income statement you will record the revenue and expenditure, and in the statement of financial position you will be recording the assets, liabilities and equity as at a given particular date. Now we will move on to another important aspects of accounting for other professionals. Earlier we have discussed the income statement and the statement of financial position. Now the next important concept that we're going to learn is accounting equation. Accounting equation. Accounting equation, as you can see, it's assets equals capital plus liabilities. Assets equals capital plus liabilities. Once again repeat, assets equals capital plus liabilities. So we will try to understand it. Now this particular equation is the basis for your statement of financial position, which we have learned in the previous slide, where it says assets of a business, right? Items owned by the business, assets of the business are financed, are funded by capital. That's the money that has been pumped to the business by the owners, and the liabilities, the money that has been pumped by the debt and credit providers to the business. So accounting equation shows the assets of the business, items owned by the business, assets are funded by the other side, the right hand side, are funded by the capital and the liabilities. Assets funded by capital from the owners and liabilities from debt and credit providers. So left hand side shows what business owns, assets, and right hand side shows who has funded it, capital plus liabilities, the equity providers, the owners, and the liabilities, the debt providers. So we will learn that through an example, right? I will give you some examples and we will try to learn it. If a business commences with £100,000 in the bank, what will be the equation be? Right? Hint, double entry bookkeeping. All transactions have two sides of recording. So we'll try to learn it. Right? Once again, I'm repeating. What is it? The accounting equation. Assets equals capital plus liabilities. Assets equals capital plus liabilities. So we said the father of accounting, Luca Pacioli, said something called double entry bookkeeping. That is, for every transaction, why? There are two sides of it. Every transaction, there are two sides of impact. So if you take this particular accounting equation, assets equals capital plus liabilities, if a transaction happens, what will happen? To this equation, there are two impacts. For the equation, there will be two impacts. Either that transaction will affect assets and capital, or assets and liabilities, or capital plus and minus, or liability plus and minus. Whatever the transaction, there are two impacts. Double entry bookkeeping, two impacts to the accounting equation. So once again, accounting equation, what is it? assets equals capital plus liability. That means items in the business are owned by whom? The owners, and are funded by the owners and the debt and liability providers. So, our question, if a business commences with £100,000 in the bank, what will be the equation will be? What will happen? Think, if a business commences with 100,000 in the bank, what will happen? That means 100,000, we have two impacts from that, right? Double entry. So that particular transaction, 100,000 in the bank account, will have what? Two impacts. So 100,000 will be invested in the business, right? If a business commences with 100,000, that means 100,000 pounds will be invested in the business. So what will happen? Pounds, that's cash, right? Cash is an asset. Cash is an asset of business. So asset will move up by 100,000, and who has put that 100,000? That 100,000 has been invested by the owners of the business. So on one side, cash will go up, and on the other side, on the right hand side, investment of the capital will move up. So assets on the left hand side will go up by 100,000 pounds, and on the other side, capital will go up by 100,000 pounds. So ultimately, this particular equation will be equated, will be balanced. Finally, what should happen? Assets should equal capital plus liabilities. So the answer to that particular question, if 100,000 rupees which is in the bank account will be invested in the business, what will happen? Cash will go up, assets will go up on left hand side, and on the other side, equity that will be provided by the shareholders, equity capital will be going up. Hint will be the double entry bookkeeping accounting system. Okay, so in the previous slide we have identified the accounting equation where we have prepared it. Assets equals equity plus liability. Assets equals capital plus liabilities. So we will learn the terminologies in a detailed manner now. What is capital? Capital is the amount of money or amounts of assets put into the business by its owners. That's capital. Amounts of money or amounts of assets put into the business by its owners. Now, capital can be invested in terms of cash. Likewise, in our previous example, an owner can invest cash, where then on the asset side the cash will go up, on right hand side the capital will also go up. Or owner can invest a building or stocks or any other furniture, motor vehicle into the business. So assets will go up, on the other side the capital will go up. That's double entry accounting, which Luca Pacioli, father of accounting, has introduced. So double entry accounting say when one side goes up, the other side will go up, other side on one side moves down, the other side will come down, or in the same side plus and minus. So capital is the amounts of cash or any other asset invested to the business by its owners. Assets means the resources controlled delivering future economic benefits. Assets are resources in the business like land and buildings, motor vehicles, then machinery, cash, sometimes the amounts of receivables to you from other parties, receivables, assets. It may be tangible assets like cash, land and buildings, motor vehicles, or maybe intangibles like amounts receivable from your debtors. Likewise, assets are resources controlled by the business. Liabilities are obligations that the business has to pay. Obligations to transfer out economic benefits. Obligations like bank loans, like amounts of money invested in the business by someone, by a lender. So it's liability, obligations that has to be paid. So capital equals, sorry, assets equals capital plus liabilities. That's accounting equation terminology. So assets are resources controlled by the business. Capital are the funds or assets put into the business by the owners of the business. And liability means external parties who have invested in the funds. So the accounting equation shows how assets of the business is funded. It can be funded by capital and it can be funded by the liabilities.